Hello, everyone. I'm Patrick Fross with Fross Fross Wealth Management, and thank you for tuning in to our virtual version of our 2026 halftime report. We had a wonderful live version on August 4th, and thank you to all those that were in attendance. But we wanted to make this available to those that couldn't attend as well. So thank you for tuning in. It seems like every time we turn on the TV or check our phones, we're hit with another headline telling us why we should be worried. Recession fears, market volatility, geopolitical conflicts, inflation, interest rates. The list never seems to end. Today's presentation is called From Chaos to Clarity, Investing Beyond the Headlines, because our goal isn't to ignore what's happening in the world, but it's to separate the noise from what really matters and focus on the facts instead of the fear, and make thoughtful investment decisions based on long-term opportunities rather than short-term emotions. So let's begin by taking a look at some of those headlines that we've been confronted with since the beginning of the year.
The U.S. and Israel striking Iran for a third day following the killing of Iran's Ayatollah.
We're now headed toward our fourth down week in a row.
Nasdaq having its worst day in more than a year, down 4%.
My issue coming into the year is risk was mispriced.
There is no base case.
We continue to cycle through these different existential fears.
We're at the mercy of headlines.
There is serious correction risk.
Hey, what is the probability that we're in an AI bubble?
Now, with that stronger than estimated jobs report, maybe the case is stronger for the Fed to hike rates sometime this year.
The European Central Bank announcing its first rate hike in 3 years.
We're sleepwalking towards a cliff.
But if we see military action resume, oil could do a beeline back to 100 a barrel. And if that happens, the Fed's in even more of a precarious position.
57% of registered voters say they disapprove of the job Mr. Trump is doing as president. Those numbers could spell trouble for his party ahead of November's elections.
A global sell-off dragging stocks lower, with South Korea's Kospi sliding 10% from its record.
Wow.
The U.S. and Israel.
That's a lot of bad news, isn't it? And that's what we were all confronted with. And just hearing all that bad news without any clarity brought to it, it would just really incite someone to want to just get conservative and get out of the market. So today we hope to be the voice of reason and sanity in an otherwise unreasonable and insane world, and cut through some of the emotion and just talk about the facts. So today we're going to talk about the economy, number one. Number two, geopolitics. Then we're going to talk about U.S. markets, U.S. political impacts, because it is a midterm election year, international markets, and then staying prepared, things that we do to help our clients navigate all this uncertainty. These are some of the disclosures to keep the attorneys happy, so please read through these. Basically, it tells us there is no perfect investment. We're not going to make a recommendation about a specific investment. That would not be appropriate at this time, because we are fiduciaries and we have to do what's in your best interest. So we would get together with you personally and learn about your goals, objectives, your feelings on risk, your tax situation, your income needs. All these things are taken into consideration before we ever give a recommendation, but we will speak in general terms. So to get started, let's talk about our first subject today, and that is the economy. This is a headline from Yahoo Finance that came out on June 5th. It was the stock market today. Nasdaq plunges 4%, down S&P 500 sink as AI trade halts on Fed hike bets. So if you had just read that headline without any color or clarity, no doubt it was something that was very fearful. But does that headline tell the real story? Well, let's jump into the economy by talking about something that has a big impact on the economy, and that's the Federal Reserve. And we know this year it was out with the old, Jerome Powell, in with the new, Kevin Warsh. This was President Trump's nominee, and he has taken the helm at the Fed. It's a regime change. And as a reminder, the Fed does have a dual mandate: promote maximum employment as well as price stability, or what could be called moderate levels of inflation, but Warsh really enters his role at a precarious time because he's being pressured to cut interest rates, but yet he said he's going to reduce forward guidance. Warsh signals a change in the status quo. He said he's going to do less hinting about where interest rates are going to go. Warsh is more concise. In fact, his speeches are 62% shorter than Jerome Powell's. He plays his cards closer to the chest and seems to have taken on tackling inflation as his top priority. Well, why is that? When the Fed has a dual mandate, price stability and or inflation and maximum employment, why is he focusing on inflation? Well, let's take a look at the labor market to see why that is the case. We see that unemployment is, for the most part, relatively low at 4.3%. That is a bit higher than it was in April of 2023 when we hit a very low rate of 3.4%. But at the same time, new jobs are being added, but hiring is slowing. At the same time, quits and firings are at very low rates. So we're in this low hire, low fire environment. And for now, it's keeping the labor market at bay. Now, as far as inflation goes, we know inflation has began to tick up slightly. If you look at the chart there, at the middle of the chart, you'll see that's June of 2022 when inflation was peaking at 9.1%. As a result of all of the stimulus, all of the cash that was printed and flooded into the market, into the M2 money supply, money that's actually in circulation being used. And as a result, we saw inflation peak. And then, of course, the Fed turned around and raised interest rates to stave that off. But in almost all categories, except for shelter, we're seeing a slight year-over-year increase in inflation. Energy leading the way, of course. Inflation remains stubbornly high, but we think the official measures of inflation would already be lower were it not for the Iran war and the ongoing conflict in Ukraine, which have raised oil prices and cut global refinery capacity. But when we read the tea leaves, Warsh told Congress recently that the Fed has other tools to fight inflation rather than just interest rates. What he's referring to is the Fed's balance sheet and quantitative tightening. Basically, trimming the Fed's balance sheet would reduce liquidity in the banking system, which would in turn help hold down growth in the money supply. The M2 measure of money supply is up roughly 4.7%, which we think is a modest annual rate in the past 24 months. And ultimately, unless money supply growth picks up, we think inflation will start to diminish from those 4.2 levels that we see right now. Now, as far as consumer sentiment, we always bring this University of Michigan survey to you because we find it very interesting. Back at the beginning of the year, the average consumer was around 52.9 on their consumer sentiment. It's currently at 44.8, and the 50-year average is around 77%. And this is really due in part to energy costs and core good prices, and they really have a direct correlation to consumer sentiment. As we see those prices tick higher, we continue to see sentiment begin to fall, and that's how people feel. That's what we're talking about. We're talking about feelings, and historically, what's interesting about this survey, it's right when people feel the absolute worst that the market historically has oftentimes started to rally and really take off. But let's take the emotion out of it for a minute, and let's talk about the facts. We're taking a look here at the Rockdale speedometers, and before we look at the current speedometers, let's take a stroll down memory lane back to October of 2022. This was really the absolute bottom of the bear market that started with really the rapid rise in interest rates to stave off inflation. And we can see a lot of red in this chart, a lot of negativity back in October of 2022. The yield curve, monetary policy, housing, interest rates, the international economic outlook, geopolitics, inflation, and so on. A lot of negativity. Fast forward to June of 2026, and we see things have improved greatly. In fact, there's no red on the chart right now. This is a nice outlook using the 20 leading economic indicators. We have a couple green: corporate profit growth and credit demand availability is all in the green. The rest of these are neutral, and we see a nice improvement in the economic outlook. So we're in the same camp as Rockdale, and we believe they have it right on the money here. Now, the road for the U.S. economy really looks like this two-lane highway. Stubbornly elevated inflation in one lane, strengthened growth and employment in the other lane. So the consensus from 72 forecasters surveyed by the Wall Street Journal is that there's about a 25% chance that we'll end up in a recession. But when you look at the consensus, the expectation is that the U.S. economy continues to expand. I know it sometimes feels like a recession is inevitable, but that's not what the facts show us. While risks always exist, the most likely outcome today is continued growth rather than a recession. Now, our second source of negative headlines this year, Geopolitics. This was a headline from CNBC published on June 8th, 2026. Oil prices may hit $150 per barrel soon if Iran war continues, energy economist says. So who else would you ask but an energy economist? And of course, he was definitely wrong about that. But those were the headlines. And if you read that headline, you thought, gosh, maybe now's the time to get out of the market. Well, why have we seen oil prices go up? Not to $150 a barrel, but why have they gone up? Well, take a look at this little swath of water here. Any idea what that is? That's right. That's the Strait of Hormuz. It's 21 miles wide. Just to give it some context, 21 miles from, that would be about the distance from our Lake Sumter office to the south end of Ocala, or from the Lake Sumter office to Mount Dora. It's a very small area, but yet it's had such a big impact. And that's because 30% of global seaborne oil moves through the strait every day. In 2024, that was 21 million barrels of oil per day moving through this narrow stretch of water. And not just oil, LNG also moves through the Strait of Hormuz, which is critical for Europe. So why does this stretch of water affect us here in the U.S.? Why? Because we are now a net exporter of oil. If you look at the chart right around 2020, we became a net exporter of oil, which means we export more than we import. So why are our gas prices going up here when we don't rely on the Strait of Hormuz? Well, it's because gas prices are set by global crude oil markets, meaning geopolitical events and worldwide supply-demand changes still affect prices at the pump. Let me give you an analogy. Imagine you live in Kansas, which is the largest wheat-producing state in the country. And imagine that wheat prices have suddenly doubled worldwide. Even though your state grows more wheat than it consumes, local farmers sell to the global market in most cases. So when wheat prices go up all over the world, that's going to affect bread prices locally. You can't expect to go to a grocery store and not see prices go up. And oil works much the same way. It's unfortunate, but that's just the case. Now, we have looked at these geopolitical events because we want to know what type of effect do they typically have. And we've shown you this chart before. In fact, we showed you this chart at our State of the Markets meeting back at the beginning of the year. The only thing that was not on here was the U.S.-Iran conflict. That hadn't happened yet, but all these other things were on there. It's very interesting that most of these happened in the Middle East. But what we find is typically when there's a geopolitical event, the average or the median number of days of the sell-off is around 12 days. The median drop in the market is about 5.6%. And it doesn't take that much time for the market to recover, on average around 20 days. So here's our third headline, or our third subject for today: U.S. markets. This is a headline from the Motley Fool, published March 27th, 2026. Is the stock market going to crash this year? History could not be any clearer on what should happen in 2026. What I find interesting about that headline is that headline was on March 27th. The market literally hit the bottom on March 30th. So really the headline should have said, the market's about to hit the bottom, time to get back into the market and to deploy as much cash as you can. But of course that's not the headline, because headlines attract eyeballs, and that's what they're trying to do here. And it certainly did, because a lot of people right at the very bottom of the market got scared and they got out and they went to cash. And unfortunately, it's going to take them many years to recover, because they sat in cash as the market recovered. But this is one of those headlines that instills fear. So let's take a look at the market. We know that there's been in 2026, as we put this slide together, there were 23 all-time highs. By now there's 24 all-time highs in the S&P 500 and 21 all-time highs in the NASDAQ. But it wasn't without volatility. We know that the S&P 500 dropped 7%. Peak to trough, it was about an 18.5% drop from the high. And year to date, when we put this chart together, the market was around 8%. Right now, as I speak to you, year to date, the S&P 500 is up around 13%. We saw something similar with the NASDAQ, a drop of about 10.5% at the end of March, and year to date, the market is back up 17% year to date. So, wow, volatility. But if you're looking only at the news, you may have made a bad decision right there at that bottom of the market. We hope you didn't. We hope you listened to us. Now, we do admit that the market is a bit pricey. It's not cheap at current levels at 20.7 forward earning PEs, but at the beginning of the year, it was around 22 times forward earnings, but not nearly as high as it was in 1999 when it peaked over 24 times forward earnings. We don't believe this is 1999 or a dot-com bubble all over again. This is a completely different market than it was back then. In 1999 and 2000, a lot of those tech companies, in fact, 70% of those tech companies were hemorrhaging cash. We now live in an environment where the S&P 500 is made up of some of the greatest companies that have ever existed in the history of the world. These are profitable companies seeing unbelievable profits, and their profit forecasts continue to rise. So we feel very comfortable with those PE ratios. It's not cheap, but earnings give those ratios merit. Earnings growth and profit margins, as we said, are justifying the multiples. Earnings are actually driving down the multiples. So there's two ways to bring down multiples. One is you have a big stock market crash and it brings down the share price of the stock. We don't want that to happen. The other way to bring down multiples is to see a very nice increase in corporate profits. The path of the S&P 500 over the last 12 months has been a 13.4% increase in earnings per share. And over the last year, Wall Street has increased its forecast for 2026 S&P 500 earnings by more than 13%. While markets will always experience volatility, rising earnings are one of the healthiest long-term indicators for stock prices, and we feel very, very good about the market right now. For the past several years, the Magnificent Seven have really done most of the heavy lifting for the market. But in 2026, that trend has reversed. The other 493 companies in the S&P 500 have gained an average of 13.93% as of June 24th when we put this chart together, while the Magnificent Seven have declined on average about 3.5%. We can see as we scroll through these different Mag 7 companies, they just haven't done nearly as well as they have in previous years. In fact, Microsoft, Meta, and Tesla as of June 24th were in negative territory, dragging down the performance of those 7 stocks as a whole. But This year, we've seen a big change. The other 493 stocks have done very, very well. This widening of market participation suggests that leadership is expanding beyond mega cap technology and into a broader set of opportunities across the market. For long-term investors, this reinforces the value of diversification and avoiding over-reliance on any single group of stocks. Really, the story for 2026 isn't that technology is disappearing. That's not it at all. It's that the rest of the market is finally joining the party. But there may be another reason. To understand what this is, we need to understand a little more about the AI cycle. This is a very important element. As we look at AI, and have you ever heard of AI? Of course you have. Probably more than you ever have in your life. We've heard so much of it. We constantly confront AI, whether it's on our phones using different programs and so on, but it's everywhere and there's no getting away from it. But there's different cycles, and experts have broken down the AI cycles into three basic phases. Phase one is create. That's where we have the picks and shovels and ChatGPT rolls out, and it's the old economy, recession, concentrated market leadership, which we've certainly seen that in the past. Phase two is catalyze. That's where we start to see data centers being built out, power grid investments, low hiring, low firing. We just mentioned that a moment ago. And of course, phase three is cascade, where we see this wide adoption of AI. We would suggest that we are in the second phase, which is catalyzed. We're seeing data centers being built, the grid needs updating, earning expectations are resetting higher, and we're in a low fire, low hire environment. We're also seeing relatively low adoption of AI, where about 20% of businesses report using AI applications. So we're really at the very beginning of AI adoption. And as we start to consider more companies adopt AI, we see efficiency start to pick up. We think it could hit the bottom line of the broad market and start to lift up some of these other AI technology companies as well. Now, let's zoom out from the Magnificent Seven a bit, and let's look at really growth, which a lot of those tech stocks are growth stocks, versus value as a whole, because we know growth has outperformed value for many years now. So which do you think is performing best year to date? Again, this is of 624. And there you go. The Russell 1000 growth up 1.4%. The Russell 1000 value up 15.5%. And although we've seen growth typically outperform value, we've seen this shift. Now, it doesn't mean that value will necessarily continue to outperform growth, but what it does mean is that the market can quickly shift and an asset class can fall out of favor while another gains momentum. No doubt as growth firms start to see profits start to grow as a result of AI adoption, we believe that those names will start to look attractive to investors again. Now, this is the forecast for the S&P 500. We bring this to you every year. I don't know why we bring it to you. It seems like they're wrong every single year. But this is the forecast. The experts were polled at the beginning of the year, and their average, if you take the average of all of their forecasts, they're forecasting about 10.69% for the S&P 500. And of course, we know that we're up, as I record this video, over 14% with 5 months left to go in the year. So we'll have to see how it shakes out. But right now, we are certainly exceeding expectations, at least the expectations of these so-called experts. Here's our fourth subject for today, the U.S. political impacts. So did we forget it's a midterm year? You know, it feels like this has really fallen to the back burner. Much less do we remember the government shutdown late last year and the continued funding bill that started to impact us this year. Do you remember long TSA lines, shortages of air traffic controllers, and so on? But we know that, as time goes on, these things start to get fixed. But let's talk a little bit about what we think the political impact would be. And of course, we know a big driver of market returns in some ways can be affected by Congress. We know the balance of power is very tight in the U.S. Senate and in the House. Right now in the House, there's 218 Republicans, 1 independent, 215 Democrats, 1 vacant seat. And we see something similar in the balance of power in the Senate with 53 Republicans and 45 Democrats. So things are very close. Now, historically, not to be the bearer of the bad news, but usually the party of the sitting president will lose seats in the midterms, albeit with 3 exceptions going back to 1934. The question is, will a shift in power have a major impact on the market? Well, if we look at over on the right side, Republican president, historically going back to 1949, a Republican president with a Democrat Congress had average returns of 7.5%, with a Republican Congress 11.4%. If it was a split Congress between Senate and House, split, one side controlling the House, one side controlling the Senate, the market seems to like that. That 17.6% are the average returns under that scenario. Why is that? Well, it's because the market loves gridlock. The market loves a split Congress. And that's because nothing's getting done. The market hates uncertainty. And when Congress is in there passing bills and spending bills and tax bills and changing laws, that has a negative impact on the market because nobody knows what's going to happen with tax law and spending and where money is being appropriated. So it creates this uncertainty and the market doesn't like it. But when there's gridlock, the market loves it when nothing gets done in Washington. Now, as far as the average returns before, during, and after a midterm election, if we look at the orange bars, the quarter between the midterm, that's the quarter we're in right now. The average return is 1.1%. The quarter of the midterm, which is the fourth quarter of this year, the average return is 7.6%, and the quarter after the midterm, even better at 8.2%. So historically, we have good returns coming in the market. But there's definitely going to be volatility. In fact, volatility in a midterm year is the highest volatility that we see during any of the other election cycle years. But the question is, should we be afraid of volatility? Is volatility a bad thing? And I would argue that while it does make you feel uncomfortable, because nobody likes that roller coaster ride, volatility is normal. It's to be expected. This chart is one that we share with you on a regular basis. We share it twice a year at our State of the Markets meeting, at our halftime report. And you know what? I wish I could share it every day because I think this chart is so important. It shows us how volatility is the expectation. It's not the exception. Just honing in on the chart here, just an example, in 1980, I don't remember 1980. I was 9 or 10 years old, delivering papers, reading the comics. I wasn't reading the business section. But back in 1980, the market at one point, peak to trough, was down 17%, but yet finished the year up 26%. That's volatility. And as we go through, like, look at 1987, the market there at the bottom, of course, Black Monday, the big huge sell-off on one day. The market was down 34% at the bottom in 1987. But if you were to ask the average person on the street, was 1987 a good year or a bad year in the market, most people would probably say it was a bad year. But the market really finished up 2%, at least for those that stayed in, not for those that got out and panicked at the bottom. In fact, I remember 1987 very well. I was a senior in high school. I had a economics class, and me and my other buddies are standing around saying, gosh, there was a big drop in the market. What should we do? Should we tell our dads to sell their 401ks and go to cash? And you know, the seasoned economics teacher came over and he said, gentlemen, this is the best buying opportunity that you'll ever see in your lifetime. You tell your dads to put more money in the market right now. And I got to tell you, a light bulb went off in my brain. It was the best piece of advice that anybody could have given a young person. And it's really guided me throughout the years. And I look at all of these different years since 1980 all the way through present, and we see there's a few years in there where the market was negative, as represented by those gray bars, but 35 out of 46 years the market was positive. That's 76% of the time the market had positive returns, even though there was a intra-year average drop of 14.2% on average. So if we ever get a year where we don't have a big drop, that's the weird year. Not when there's a drop. This year the market was down around 8%, and everybody was panicking and fleeing for the exits. Well, hopefully not everyone, not our clients, but those that listened, they stuck to it. But a lot of people that didn't have the kind of advice that we're able to give our clients, they were panicking. And yet it's normal. Market volatility is normal. It's nothing to be feared. Taking a look at international markets, our fifth subject for today. This news headline is from CNBC, printed on April 20th, 2026. European stocks slide as Gulf tanker attacks threaten fragile ceasefire. So as you look at that, you're thinking, man, I should not be in international stocks. It looks really, really bad. What do we see, though? As we take out the noise and we look at the facts, what do we see in international markets? Well, we see really what's unusual is beginning in 2025, and we brought this to you at our halftime report a year ago, that we are seeing big fund flows in international ETFs and international stocks over really Liberation Day and tariffs and a lot of repatriated cash in Europe. And we saw the international, like the EFA, outperform the U.S. by almost 15% last year. And those trends have continued. We're seeing more of the same. We're seeing international outperforming U.S. stocks. And what's one of the reasons why we're seeing that? Well, it's because of the discounted price of international to U.S. The 20-year range is around a 20% discount. Right now, international stocks are trading at about a 30% discount to U.S. equities. So, after years of U.S. outperformance, investors are increasingly looking abroad for value and diversification. While we continue to prefer U.S. equities, we've modestly increased international exposure where valuations and fundamentals support the opportunities. This isn't a shift away from the U.S., but rather it's a disciplined approach to capturing opportunities wherever they exist. So, what can we do? What can you do to stay prepared and to tune out all of this noise and really look beyond the noise, beyond the chaos, beyond the headlines, and really make good, sound investment decisions based on the facts? Well, one of the things that we wanted to share with you is the power of diversification. This chart shows diversification for the long run. The gray bar is an all-equity portfolio. The green bar is a 60-40 stock-to-bond portfolio. And we see if you're one of those that prefers having more days of positive returns, we see that in 1 day, 1 week, 1 month, 1 year, 3 years, 5 years, and 10 years, a 60-40 portfolio versus an all-equity portfolio on average has more positive returns, frequency of positive returns across all those time frames. Now, in all fairness, if you're in an all-equity portfolio, your returns over the long term potentially could be higher, but you're going to have more negative days, and it's going to be much more of a roller coaster ride. So if you're looking for more stability, there's things that we can do. This is a very simplistic chart. It doesn't go into great detail. There's things that we do behind the scenes as you peel back the curtain. Not just 60-40, but different asset classes within those equities, different asset classes within those fixed income sleeves. So there's things that we do to even more diversify the portfolio and protect our clients. Now, we don't have a crystal ball. We can't tell you what's going to happen in the market tomorrow, much less next year. But what we do know is we do have history. And history is a very good guide. I know history does not always prove to be a perfect indicator of future results. And because we don't have a crystal ball, we use math. We use probabilities and statistics. And this chart is very interesting because it shows us focusing on the middle of that chart there. In any 12-month rolling period, you have about a 77% chance of positive returns. But on the flip side, that means that 23% of the time the market is negative. So for those that take income from their portfolio, we have to be very careful. We can't have all of your assets in equities fully invested, because there's too much of a chance, 23 at least to us as financial planners, that's too much of a chance of negativity, or what we call sequence of return risk. We don't want to have to sell assets when the market's down. So we mitigate that risk by using lower risk assets for short-term needs. And we'll show that to you in a moment and illustrate how that works. But as we move forward in time frames, 5-year 93%, 10-year 97.4% of the time the market is positive, and that's really, really good math. If you could go to Vegas and win 97% of the time, you'd probably go. So I think long-term money, this really illustrates why long-term money should be more aggressive. And this also illustrates why we use what's called the buckets of money approach. So this is how we mitigate that sequence of return risk. Now money you need in the first 12 months should be more conservative. We're talking about cash, money market, CDs. We can't tolerate a penny of loss in your 1-year short-term money. But as we get to the soon money, or money that's out 2, 3, 4 years, that's an inflation hedge. Short-term bonds, structured notes, things that we can do to beat inflation but still mitigate that volatility and bring down the chance that you're going to lose money in that bucket. However, later buckets, money that's long-term growth money, should be more aggressively allocated. Now, this is a very simplistic approach. It's actually much more sophisticated than this. Typically, we use 5 buckets with different asset classes within the buckets, but this is a nice generalization. It gives you an idea on how we help grow and protect assets for our clients. These are a few of the headlines that we saw. NASDAQ plunges, oil prices may hit, is the stock market going to crash, Senate fails to advance, European stocks slide. But really, what is all this? That's right, it's noise. All of this is noise. And what we ask you is to look beyond the noise. Come to us. When you're worried about the headlines and you have a question about how your portfolio may be affected by what's going on in the world, please contact us, come in, call us on the phone, come into the office. We'd love to sit down and talk to you. For those of you that aren't clients and you'd like to, chat about your financial situation, see if there's anything we can do to help you, feel free to give us a call. We'd love to spend some time with you. Again, these are some of the headlines. I know it's very, very overwhelming. And of course, we always want to be the voice of reason and sanity in an otherwise unreasonable and insane world. And we want to do that by presenting a very balanced view of what's going on there based on the facts. So what I'd like you to do is take a minute and look at one of the commercials that are airing on TV, because it gives you a nice view of how we help grow and protect assets for our clients.
Wall Street took a startling dip.
Are you feeling like your financial advisor is 1,000 miles away? Now imagine a real conversation, face to face, and letting go of the stress when markets dip, because you actually understand your financial plan. A plan designed around your life. Clear in direction, steady in capable hands. Still imagining? Here in the Villages, with Fross Fross Wealth Management, you don't have to.
So some of you may have seen that commercial, among others, on TV. Our job is to look beyond the headlines and give you a clear understanding of what actually matters to you and your retirement. Thank you for the trust that you've placed in us. We don't take that responsibility lightly. And thank you for watching our presentation, our halftime report for 2026, and on behalf of all the advisors and staff at Fross Fross Wealth Management, it's been a pleasure to be able to spend time with you and share our thoughts on the economy, the markets, and how we're working to protect and grow your wealth. I just want to take a minute to introduce our team. This is our investment committee, starting at the top and going around clockwise. Zechariah Montera, Casey O'Rourke, Tucker Woods, Renee Springstead, Thomas Fross, and sitting there at the bottom right, myself, Patrick Fross. So thank you so much. It's a pleasure to be able to speak to you today. If you have any questions about what you've seen, hear, or heard, please reach out, and we'd love to talk to you. Have a great day.